All right, everyone, get ready. Because today we are going deep, deep into the world of finance. We're going to be talking about Fed policy, the market's reaction to it all, and of course what it means for, well, for you and me.
Yeah, it can seem a bit like trying to solve a puzzle, but that's why we're here.
Exactly. And we have a lot of puzzle pieces to put together, especially after Jerome Powell's recent announcements.
Hmm.
He decided to keep interest rates right where they are, an average of 4.3%. No cuts, but importantly, no hikes either. But the thing that really got everyone talking was, well, it's kind of subtle, but he changed how he talked about inflation a bit.
Right. He always used to say they were making progress towards the 2% goal, remember?
Oh, yeah, he always said that.
This time, gone. Just poof, disappeared.
And that little change, just not saying that phrase, it really did a number on the market. In fact, the stock market actually jumped up significantly, I might add, within just 2 minutes of Powell starting to speak.
2 minutes. Yeah, it was almost like they were just waiting for him to say something, anything.
That's incredibly fair. I mean, what could possibly explain that kind of reaction?
Well, after that December 18th meeting, the one where Powell's comments, I think it's fair to say, kind of sent everyone into a bit of a panic. I think the markets were, well, they were bracing themselves for the worst this time, but there were a couple of things that might have helped to calm things down, so to speak.
Okay, like what?
First, Powell basically did a complete 180 on tariffs.
Really? How so?
Well, back in December, he seemed really worried about how they might impact, the Fed's policy. But this time basically said, we're not seeing a big effect from them yet.
So is he just ignoring the issue?
Yeah.
Because tariffs could still have a huge impact down the line.
Oh, absolutely they could. But right now, all we've had is talk, a lot of back and forth and threats. We haven't seen any new tariffs actually put into place. So Powell's basically saying, let's wait and see what happens, taking a cautious approach.
Okay, I get that. But still, the market's reaction seems a bit extreme, doesn't it?
Well, here's the thing. By kind of downplaying the whole tariff threat, Powell basically eased a big fear in the market that the Fed would raise rates preemptively.
Because of the tariffs. I don't follow.
Right, so tariffs can make things more expensive, right?
Yeah.
And when things get more expensive, you get inflation. And when inflation goes up, the Fed, well, they typically raise interest rates to try to cool things down. So by saying, hey, these tariffs, they're not a huge deal right now, Powell basically signaled that rate hikes might not be coming as quickly as everyone thought they would.
Ah, so it's all about managing expectations. The market was expecting, like, a total disaster, and Powell gave them, well, maybe not good news, but not as bad as they were fearing.
Yeah, exactly. And even just that little bit of hope, was enough to send stocks way up.
Interesting. Okay, so we've got stable interest rates, at least for now, a pretty big change in tune on tariffs, and it seems like maybe a more relaxed view of inflation. Is there anything else we need to be paying attention to?
Hmm. Well, Powell did touch on the labor market, specifically the possibility of layoffs. He acknowledged that with the current hiring rate being so low, any significant number of layoffs could really push the unemployment rate higher.
So is that something we should be worried about?
Not necessarily. He also said that that layoffs aren't a major concern at the moment, so it's kind of a mixed message on the jobs front, I guess you could say.
A bit of a wait-and-see situation. All right, well, we've covered a lot of what Powell had to say, but what does all of this actually mean for everyday people? I mean, what can we take away from this and actually apply to our own lives?
Right. Let's break it down and make it, a little more relatable. First off, that stable interest rate environment we talked about, that's good news for anyone who's thinking about saving money. You don't have to worry about interest rates suddenly jumping up on things like savings accounts.
That's always good to hear. But what about people who are thinking about buying a house? Should they try to lock in a mortgage rate now before things change?
That's a really good question. It really depends on each person's situation. If you're ready to buy and you find a rate you like, yeah, locking it in could be a good idea. But remember, interest rates are just one factor when it comes to buying a home. You have to think about things like your down payment, your overall finances, and of course, your long-term goals.
So don't panic and rush into a mortgage just because you're afraid rates might go up. Make sure it's the right move for you, for your situation.
Exactly, exactly. And speaking of making good decisions, let's go back to that whole layoff thing Powell mentioned. Should people be like freaking out and updating their resumes right now?
I have a feeling you're going to say no.
You're right, I am. Panicking never helps anything. The best thing to do is, Well, to stay informed about what's happening in your specific industry or job market, keep up with industry news, talk to people in your field, and just be ready to adapt if you need to.
So it sounds like being prepared and being able to adapt, well, that's really important. But let's switch gears for a minute. Let's talk about something that always seems a bit mysterious, kind of like shrouded in secrecy. And that is, well, it's quantitative tightening.
Oh, yeah.
Even just saying the phrase, it makes my head spin a little bit, to be honest.
It does sound a bit intimidating, doesn't it?
It does.
But honestly, it's not as complicated as it might seem. Just imagine the economy is like a giant bathtub.
Okay, a bathtub.
Right. And the Fed, they're the ones controlling the faucets. So when they want to boost the economy, they turn on the hot water tap and add more money into the system. That's quantitative easing.
Okay.
Quantitative tightening is kind of the opposite. It's like turning on the cold water tap and draining some of that extra money out.
So they're basically trying to control how much money is sloshing around in the economy.
Exactly. And they do this by selling off assets, things like bonds that they've accumulated on their balance sheet. This reduces the amount of money that's actually circulating, and that can help to cool down inflation. It's kind of like, well, when there's less money available, people tend to spend less, which can help to bring prices down.
Okay, that makes sense. But how does this quantitative tightening thing actually affect, the average person? Like, I'm not exactly trading bonds on Wall Street over here.
Well, it can create a ripple effect, throughout the whole economy. For instance, as the Fed sells off those bonds, interest rates tend to go up.
Oh, okay.
And that means borrowing money for things like a mortgage or a car loan, or even just using your credit card, it all gets more expensive.
Yeah, that doesn't sound so great for borrowers.
Yeah, it can definitely be tough, but on the other hand, higher interest rates can be good for savers, right? They earn more interest on their savings accounts and things like that. So it really depends on your specific situation. It can be a good thing or a bad thing.
Yeah, like one of those seesaws, one side goes up, the other goes down. But I'm a little confused about the timing of all of this. Powell says he wants to keep interest rates steady, at least for now, but quantitative tightening usually leads to higher rates, doesn't it? I mean, isn't that kind of a contradiction?
That's a great point, and this is where things get, well, pretty complex. The Fed's trying to walk a really fine line. They want to get inflation under control, but they don't want to do anything that could, disrupt the economy too much. So they're sending, I guess you could say, mixed signals, keeping those short-term interest rates stable while at the same time tightening up the money supply through quantitative tightening. It's a delicate balancing act, for sure.
Yeah, like trying to tap the brakes and step on the gas at the same time.
Yeah, pretty much.
Right.
And it's hard to say how this will all play out in the end. It's definitely something we need to keep an eye on.
For sure. Well, speaking of things that can affect our wallets, let's talk about the housing market. With everything going on with interest rates and this quantitative tightening, what's happening in the world of real estate these days?
Well, as we've talked about, rising interest rates can have a big impact on the housing market. When interest rates go up, mortgage rates go up too, and that means buying a home becomes more expensive, which can, cool down demand and lead to slower price growth or even price declines in some places.
So, is now a good time to buy a house or a bad time? What do you think?
Well, that's the million-dollar question, isn't it?
It is.
And there's no easy answer. It really comes down to each person's individual circumstances, their finances, and what they're hoping to achieve, their goals.
I know. It's the classic "it depends"
Yeah.
answer. But are there any general trends or insights you can share? Anything to help us make sense of what's going on in this crazy housing market?
Well, one thing to remember is that the housing market is very, very local. What's happening in one city or even one neighborhood could be totally different from what's happening somewhere else. So it's crucial to do your research and really understand the specifics of your local market.
Right. So don't just rely on those national headlines.
Yeah.
Really get into the details of what's happening in your own area.
Exactly. And beyond the local factors, you also need to consider your own personal timeline. If you plan to stay in a home for a long, several years, those short-term ups and downs in the market might not be as important. But if you're thinking about buying and then selling again relatively quickly, well, then timing becomes a lot more critical.
So whether you're, a seasoned homeowner or a first-time buyer, it really pays to be informed. Do your research, understand the market, and make decisions based on your own your own unique situation.
Couldn't agree more.
Last time we were together, we left you with a pretty big question, and that was, how do our individual choices, like our everyday decisions,
Mm-hmm.
actually affect the big, massive economy?
Yeah, it's easy to feel like what we do doesn't really matter that much, like we're just one tiny little piece of this giant puzzle.
Right, a drop in the bucket.
Exactly. But the truth is, every single one of us plays a role in shaping the economy. Every time you buy something or put money in your savings account or even just decide to hold on to your cash for a bit longer, you're participating in the economy.
And all of those individual decisions, I mean, there are millions and millions of us making them every day. And when you put them all together, well, they have a pretty big impact.
They do. It's like this giant feedback loop.
A feedback loop.
Yeah, like our choices affect the economy and then the economy affects our choices right back. It's all connected.
So it's not just that the economy is this big, scary thing that happens to us. We're actually a part of it. We're helping to create it.
Exactly. And understanding that can be really powerful. It means we're not just, you know, along for the ride. We have a say. Our decisions matter.
I like that, feeling empowered instead of, helpless. But with all this talk about, the economy maybe not doing so well and all these potential risks, how can we make smart choices to protect ourselves financially?
Well, there's no one perfect answer, no magic formula. But there are some basic principles that can help. First and foremost, knowledge is power. We've talked about this a lot, but it's really important to stay informed. Pay attention to what's happening in the economy, understand the forces at play, and be aware of, the potential risks and opportunities.
Right, like ignoring the problem won't make it go away.
Exactly.
No.
And the second principle is diversification. Don't put all your eggs in one basket, as they say. Spread your risk by investing in different things: stocks, bonds, real estate, even things like precious metals or cryptocurrencies if you're comfortable with a bit more risk.
So don't bet everything on one horse, Spread those bets around.
Exactly. And finally, and this might be the most important one, have a plan. Think about what you want to achieve financially, whether that's saving for retirement, buying a home, starting a business, or even just building a safety net. And then make a plan to get there. A plan that takes into account, how much risk you're comfortable with and how much time you have.
Like charting a course through those choppy economic waters we were talking about earlier.
That's a great way to put it, yeah. And remember, financial planning, it's not something you just do once and then forget about. It's an ongoing process.
Mm.
You need to keep reviewing your plan and making adjustments as things change in your life.
Like tending a garden. You have
Uh-huh.
to keep weeding and watering and pruning to make sure it stays healthy.
Exactly. A great analogy.
Well, we've certainly covered a lot of ground in this deep dive, haven't we? We talked about Powell's announcements, tried to unravel this whole quantitative tightening thing, and even explored the wild world of the housing market. It's been a lot.
It has, but hopefully we've been able to shed some light on things and help you connect those sometimes confusing economic concepts with your own life.
I hope so too. And speaking of connecting things, before we wrap up today, I want to leave you with one final thought. We've been talking a lot about the Fed's role in managing the economy, but what about our role? What about the role of individual consumers, people like you and me? How do our spending habits, our savings decisions, all of those choices we make every day, how do those contribute to the overall picture of the economy?
That's such a great question, and it's one that I think we could spend a whole other deep dive exploring.
I think so too.
Yeah.
But for now, we'll have to leave it there.
Yeah, but hopefully it's something you'll keep thinking about.
Absolutely. And on that note, we'll say goodbye for today. Thanks for joining us on this deep dive into the world of finance and economics.
Thanks for having me. Always a pleasure to dive into these topics with you.
And to all of you listening out there, stay curious, stay informed, and remember, knowledge is power, especially when it comes to your money. Until next time, take care.